In this section, we are going to cover contingent asset and contingent liability. What do we mean by contingent asset? Contingent asset is something which a firm is likely to receive on a future date from an uncertain future event. For example, suppose, let's say, we have filed a case against someone and we're asking for damages of let's say, an amount of 10 lakhs. Now, this 10 lakhs, is there any surety that we will get this amount? Answer is no, because the case is going on in the court. Once the court gives us the verdict, if the verdict is in our favor, then we might receive the amount in future. So in this case, we have a future receivable. Asset means it's a receivable. From where should I receive the amount? From an uncertain future event. What is the uncertainty? The whether we win the case or not depends on the court's judgment. So this is what we call it as contingent asset. So a quick recall: contingent asset is something which a firm is likely to receive on a future date from an uncertain future event. Now, uh, what I should do with this contingent asset? So in other words, what is the disclosure part for contingent asset? Now let's focus on this one right now. The answer is simple. Contingent asset cannot be shown in the books of accounts for the reason because of prudence concept. What the prudence says, the concept says that do not anticipate profit, provide for all possible losses. Since contingent asset is a receivable amount, I can't anticipate that I will win the case and I can't enter the amount in the books of accounts now itself. I have to wait till we win the case. So until the receivable is certain, we can't enter the amount in the financials. So contingent asset cannot be shown in the books of accounts. But what we will do is, in the director's report, in case of companies, in the director's report, we will disclose that we have a contingent asset to the extent of so and so amount. So contingent asset is a receivable from an uncertain future event. Now let's look at the theory part here. Contingent asset, what is given here, arises from a past event. What is a past event? Suppose I have purchased a machinery. From this machinery, uh, I have faced some losses. Some fire has happened. Some because of this faulty machinery, I am incurring some losses. Now, what I will do? I will sue my supplier. So, what is the past event here? The purchase of machinery previously is our past event, and their existence will be confirmed only by occurrence or non-occurrence of one or more uncertain future event. Now, what do we mean by this sentence? Uncertain future event. It means that whether we will win the case or not is not in our hands. So the uncertain future event is nothing but the court. So they have to decide whether I will receive the money or not. So that's why we are saying it as a contingent asset. Now, if you look at this section also, a contingent asset may be defined as a possible asset that arises from a past event and whose existence will be confirmed only by occurrence or non-occurrence of one or more uncertain future event, not, this is the key point, wholly within the control of the enterprise. It's a keyword, not wholly within the control of the enterprise, meaning whether I will receive this amount or not, I cannot decide. It's not in my control. The court has to decide it. It usually arises from unplanned or unexpected event that give rise to the possibility of an inflow of economic benefit. Here we are referring to the cash component. So if I win the case, I will receive the money, right? That's what we are referring here, inflow of economic benefit to the business entity. For example, a claim that enterprise is pursuing through legal process where outcome is uncertain is a contingent asset. It should be meaningful, I guess. Now let's move on. As per the concept of prudence, this is another important topic. So for contingent asset, prudence, what it says, as well as present accounting standards. If you want to know the accounting standards, what are accounting standards? Accounting standards are nothing but a set of guidelines given to us for preparation and presentation of financial statements for some complex transaction. Whenever some complexity is there, how to address the complexities in the financial statements, I need some rules and regulations. That rules and regulations are given by accounting standards. This is just a brief overview about accounting standards. Now, with regarding to contingent asset, AS 29. AS 29 talks about contingent asset. It says that, and AS 29 as well as prudence concept says that enterprise should not recognize a contingent asset. This is a key point. should not recognize. The firm cannot recognize the contingent asset in the books of accounts. These assets are uncertain and may arise from a claim which an enterprise pursues through legal proceeding. There is uncertainty realization of claim. It is possible that recognition of contingent asset may result in recognition of income that may, this is the key point, never be realized. So this income can never be realized. So anticipating some future income, I can't book it in the books of accounts now itself. However, when the realization is virtually realization of income is virtually certain, then the related asset no longer remains a contingent asset. Now, what is the meaning here? It says that once the receipt is virtually certain, what it means? It means that suppose if we have won the case, the court has given the order in our favor, then what we can do? The firm can recognize the receivable in the books of accounts. So it's no longer contingent asset; it becomes an actual asset and a receivable. Look at the second para. A contingent asset need not be disclosed in the financial statement. It's a key point. Contingent asset need not be disclosed. Should not be need not. It should not be disclosed. So we don't have any option to disclose contingent asset. A contingent asset is usually disclosed in the report of approving authority board of directors. So in the directors report, when the firm prepares the annual report, what is annual report? It's nothing but it's a document given by the firm, which will show us the performance of the company for the past 1 year. So what they have done, what is their future plans, all these things will be discussed in the annual report. In annual report, one section will be there, which is called as the director's report. In director's report, a para will be mentioned that the firm has filed a case against so and so person, and there's a receivable of so much amount of money on a future date. So that contingent asset will be disclosed in the director's report and not in the financial statements. That's it with regarding to contingent assets. It's a very simple concept. It's really short one. A quick summary. So contingent asset is something receivable in the future, but whether we will receive the amount or not is based on some uncertain future event. What is that event here? Nothing but the court case. So the court will decide whether we will receive the money or not. So contingent asset cannot be disclosed in books of accounts. It has to be shown in the director's report in the annual report. That's it. Over. Now we'll move to the next one, which is contingent liability. Now, just like contingent asset, we have contingent liability. It's an easy guess now. Since we know about contingent asset, it's very easy to guess the contingent liability. So just the opposite case. It's like someone has filed a case against us. Now, whether I should pay the money or not, I cannot decide. What will happen? The court has to decide in this case. So the person has filed a suit against us. So whether we have to pay the money or not is in the court's hands. So that's what we call it as contingent liability. Now, contingent liability, look at this theory section, a possible obligation. So there's a possibility that I might have to pay the amount in future from the past event and may arise in future depending on the occurrence or non-occurrence of one or more uncertain future event. The same story. What is this uncertain future event here? Nothing but the court's verdict. So whether the court will give the verdict in my favor or the other person's favor will depend on the court's judgment. So that's the uncertain event here. So contingent liability means an obligation to pay might arise depending on the one or more of the uncertain future event. Now let's look into this section, contingent liability. So in contingent liability, this is a very, very important topic. We have two key parts. What are those? First, contingent liability can be defined as a possible obligation. It's a very key word. A possible obligation that arises from past event and the existence of which will be confirmed only by occurrence or non-occurrence of one or more uncertain future event not wholly within the control of the enterprise. This is the same sentence we saw in the previous page. Now, let's look at the second definition also. Instead of possible obligation, it could be a present obligation. Now, what is the difference between these two? I'll give you an example. Just look at the content here. Contingent liability is a present obligation that arises from past event but is not recognized because. So, what they are saying, there's a present obligation now. from a past event, but it's not recognized. Why? Because not probable that an outflow of resources embodying economic benefit will be required to settle the obligation. What is the meaning here? It means that suppose a case is going on in the court. Now we have asked our we have gone for a legal opinion. Our lawyers are saying that we might win the case. So the case is going in our favor. So based on that opinion, what I will do, this will be here. The obligation to pay may not arise here. So that's what they're saying here in the sentence. There's a present obligation that arises from a past event, but is not recognized because why? It is not probable that an outflow of resources embodying economic benefit, you can simply take it as outflow of resources embodying, this is nothing but payment of the money. So outflow of resources, what? I have to make some payment. No, that's what they're referring here. So whether we have to pay the amount or not is not probable. That means what? The probability of paying the amount is quite low, meaning we are likely to win the case. So in those scenarios also, we will call it as a contingent liability. So I repeat, there's a present obligation. What obligation? Someone has filed a case against us asking for damages. So there is a present obligation, but the obligation to pay the amount is quite remote because the case is going in our favor. So we might win the case now. There is no need to pay the amount, right? So that's what we're calling it as not probable that outflow of resources will be required to settle the obligation, or a reliable estimate of the amount of the obligation cannot be made. So we are unable to estimate what will be the amount we have to pay in the future. So if we lose the case, what I have to pay, we are quite uncertain about the amount. In those areas also, we will call it as a contingent liability. So case is going on, but we are not sure about the quantum of damages we have to pay. So in that scenario also, we call it as a contingent liability. Now let's look at an example here. X sells a machine to Mr. Y. So X is selling a machine to Y. Any damages incurred by Y while using the machine need to be compensated by X. A few days later, so what is the scenario here? We are X, we have sold machine to Y. So any damages if Y incurs, we have to make good of it. We have to compensate him. So what happens? A few days later, from the date of sale of machine, Mr. X received a notice from Y who is claiming damages of 20 lakhs. So by using the machine, Y is claiming damages of 20 lakhs from us. The notice mentioned that worker met with an accident during the use of the machine and is required to be compensated. Now, what they're saying here? They're saying that the Y, who is a customer, they have used our machine, and while using the machine, one of their worker has met with an accident, and they're asking a damage of rupees 20 lakhs. Now, in this case, whether I have to pay this 20 lakhs or not has to be investigated, right? Just because he is asking for 20 lakhs, I cannot pay it out immediately. So there is investigation has to go on. Only when there is a defect from our side, only then we will have an obligation. So till now, nothing has been confirmed yet whether the defect is from our side or it's because of the worker's mistake he has met with an accident. It's not clear right now. So in this case, what happens? This 20 lakhs, the damages he's asking for is going to be a possible obligation. There is no present obligation till now. It's only a possible obligation here. Look at this section. The receipt of this notice does not suggest that X is liable to pay the amount, although this needs to be investigated and confirmed as whether the damages arose due to, this is a key point, defect in the machine, which is our from our side. If there's any mistake in the machine, now we are responsible for it, or it is due to negligence while operating the machine. So whether because of his negligence he is facing the losses of brother is not clear till now. Although the receipt of the notice results into an event which requires recognition of contingent liability. Since he is asking for damages, there is a possibility that I might pay the amount. I have to pay the amount in future, right? So we have to disclose this information to the users in financials. So what I will do in contingent liability, I will disclose this one saying that Y has filed a case against us. So if we lose the case, we might have to pay 20 lakhs in future. That information has to be disclosed to the users in as a note in the contingent liability. And what is the disclosure of contingent liability? Contingent liability will not be disclosed in the books of accounts, meaning in financials. I should say books of accounts, it will be financials. In financials, I will not show contingent liability. Then what I will do? Contingent liability will be shown as a off balance sheet item. What is the meaning of off balance sheet? Outside the balance sheet, in notes to accounts, I will give a disclosure saying that the firm is liable for so much amount to so and so person. This kind of information will be given as a notes to accounts in the financial statements. So I repeat, contingent liability will not come into the books because only the actual liabilities will be shown inside the books. Contingent liability will be shown outside the books. So contingent liability will be shown in the notes to accounts. So in the notes to accounts, we have to say that the firm is liable to this person for so and so amount. That kind of information will be given to the users of financial statements. Now, let's take up another example. Look at this para. Take another example. Let us assume Mr. AB sells car to its customers. So we are AB. We are selling the car to our customers. One of the cars caught fire due to malfunctioning of a faulty part during the test drive by one of the customers. The customer has filed a court case seeking a claim of 50 lakhs due to the incidents. So the customer has filed a court case asking for a claim of 50 lakhs. Now, what they're saying here, we have sold cars to our customers. One of the car was caught by fire due to malfunctioning of a faulty part. Now, this point is clear. That means, so there's some defect in the car which we have sold to a customer. There is some defect in the car. Because of this defect, the car has got some fire during test drive. The customer has filed a case against us for 50 lakhs. He's asking for a damages of 50 lakhs due to this fire accident. Now, here one thing is sure. So, there is some mistake in the car. So, that means in this case, what happens is, while Mr. AB acknowledges that there is a present obligation. Now, this should be meaningful here. There is a present obligation now. It is not certain whether he is expected to pay for the damages. So whether I have to really pay for these damages or not, it's still not clear. The final outcome will only be known during the court proceedings. Only when the court gives us the verdict, we will know about this obligation. Whether I have to pay the amount or not, it will depend on the court's judgment. So here, what we have to do, a contingent liability is a possible obligation arising from past event and may arise in future depending on the occurrence or non-occurrence of one or more uncertain future event. A contingent liability may also be a present obligation that arises from past event, which is the part B of the definition. So there are two cases. One first situation is a possible obligation could be there, where whether there's a defect on our side or not, when it is not confirmed, it's a possible obligation. But when there's defect from our side, it will be called as a present obligation. This is the main difference. So once again, let's look at this provision here. So even though I have a present obligation, then why I'm not showing it as actual liability? Because the probability of paying the amount is quite low, meaning the lawyers are giving the opinion that we might win the case. So in that scenario, what I will do, I will show it as a contingent liability. Or the other scenario is, okay, there's a present obligation, but a reliable estimate of the amount of the obligation cannot be made. So I'm unable to make a exact quantification of the amount cannot be made now. We will say it as a once again contingent liability. It's not an actual liability. So that's it. So look at the section. An enterprise should not recognize a contingent liability in the balance sheet. This is a key point. However, it is required to disclose in the notes to accounts unless possibility of outflow of resources embodying economic benefit is removed. These liabilities are assessed. This is another key point. These liabilities are assessed continually to determine whether an outflow of resources embodying economic benefit has become probable. What is the meaning for the sentence? It means that at every balance sheet date, we have to make this analysis. So we have to check whether it's still going to be a contingent liability or whether we have to show it as an actual liability. So if the probability, so the nutshell is when the probability of paying the amount is very low, which means if the case is going in our favor, we will show it as a contingent liability. Suppose if the probability of paying the amount is quite high, that means what I have to do, I have to show it as an actual liability. In that scenario, what I have to do is I have to create a provision then. So that's the difference between contingent liability and provision. So provisions will be created when the probability of paying the amount is quite high. If the probability of paying the amount is quite low, we'll show it as a contingent liability. That's the difference. Um, that's it. So with this, we'll wind up the section. Thank you.